For decades, buying a home was the cornerstone of the American dream. You work hard, save up, get the mortgage, and build equity for the future. It was the safest bet you could make. But in 2026, the math has completely changed, and millions of people are locking themselves into a deal that may cost them, not make them, wealth. Today, we're breaking down exactly why home ownership is no longer the no-brainer investment it once was, and what smarter alternatives actually look like. Let's start with the numbers, because they're brutal. In 2020, the average 30-year mortgage rate was around 3%. Today, rates are hovering near 7%, and experts aren't expecting them to drop significantly anytime soon. That means on a $400,000 home, you're paying nearly $800 more per month than you would have just 5 years ago. Meanwhile, home prices haven't come down to compensate. In most major metros, they've barely budged, or they're still climbing. The result? The monthly cost to own a home now exceeds the cost to rent the same property in the majority of U.S. cities. That has never happened consistently until now. Here's what the real estate industry doesn't put in the brochure. Your mortgage payment is just the beginning. Add in property taxes, homeowners insurance, HOA fees if applicable, and routine maintenance. And most financial advisors say you're realistically spending 2 to 4% of your home's value every single year just to own it. On a $500,000 home, that's up to $20,000 a year in non-equity costs, money that simply disappears. Then there's liquidity. Your money is trapped. If the market shifts, if you need to move for a job, or if an emergency hits, you can't just tap that equity quickly or cheaply. Homes are illiquid assets in a world that increasingly demands flexibility. Now let's talk about what you're giving up. The classic argument for home ownership is that you're building equity instead of paying rent. But let's actually run that math. If you take a $100,000 down payment and invest it in a diversified index fund instead, historical averages suggest it could grow to $300,000 or more over 20 years. Over the same period, your home may appreciate, but after accounting for interest, taxes, maintenance, and transaction costs, the real rate of return on residential real estate is typically between 1 and 3% annually, barely ahead of inflation. Meanwhile, the renter who invested that down payment, they've potentially built far more wealth with none of the headaches. This is called opportunity cost, and it's the argument that's changing how an entire generation thinks about housing. There's also a lifestyle shift that can't be ignored. The average American now changes jobs every 4 years. Remote work has untethered people from specific cities, and younger generations are prioritizing experiences, flexibility, and financial freedom over the white picket fence. Tying yourself to a 30-year mortgage in a single location can be a massive career and life limiter in an era where your best opportunities might be in a completely different city or even country next year. Renting, by contrast, keeps your options open. And in 2026, optionality has enormous value. Now, this doesn't mean homeownership is never right for anyone. It means you need to look at it clearly as a financial decision, not an emotional one. If you have a stable career in one city, plan to stay 10+ years, and have a substantial down payment without depleting your savings, buying can still make sense. But if that doesn't describe you, consider these alternatives. 1. Invest the equivalent of your down payment in low-cost index funds and let compound growth work for you. 2. Rent strategically in a location that maximizes your income and quality of life. 3. Explore REITs, or real estate investment trusts, which give you real estate exposure without the headaches of ownership. The homeownership dream isn't dead, but it's no longer automatic wisdom. In 2026, the smartest thing you can do is run your own numbers and make the decision that actually builds your wealth, not just your sense of security. If this made you think differently about your financial future, share it with someone who needs to hear it. And subscribe for more honest conversations about money that the mainstream won't have.